Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Izzat bin Sabban. My metric number is 1211719. Today I will present about the introduction. The introduction is risk management is crucial for successful business, as it involves understanding how different assets and investors trade off risk and return. Islamic banking, in its early stage, faced risks similar to those experienced by regular financial intermediaries and unique to Islamic bank due to their adherence to Sharia Islamic bank. Islamic bank must deal with two types of risks, those comparable to regular financial intermediaries and those exclusive to them due to their adherence to Sharia. Islamic bank have distinct asset and liability side with distinct risk characteristics. Saving and investment deposits are held in profit-sharing investment accounts on the liability side, which can be divided into restricted and unrestricted categories. Demand, deposit or checking current account have the same characteristic as interest-free loans, fully repaid upon demand. Alright, next the definition. Risk is defined as the chance of loss, possibility of loss, dispersion of actual from expected result, probability of outcome being different from expected, and the significance of hazard in terms of likelihood and severity of possible adversity. It is the unpredictability that decision makers must contend with and can be quantified in various ways, including dispersion, value at risk, and likelihood, regularity, and also severity of loss. Risk management is a methodological strategy for addressing unintentional losses by planning for them, implementing them, and reducing their likelihood or financial effect. It involves building an acceptable internal control structure, maintaining effective risk measurement, mitigation, and monitoring process, and developing an appropriate risk management environment. Islamic bank must construct systems that recognize, measure, monitor, and control various risk exposure while clearly defining their risk, objectives, and strategies. The ultimate objective of risk management is risk control, which can be achieved through quantitative and qualitative assessment of risk. That's all from me. Thank you.
Okay, now we go for a look at the risk based on risk categories according to Islamic banking. Firstly, market risk is defined as the loss that may arise as a result of changes, market factors, and policies in the economy. This change is possible to affect the value of financial instruments and revenue related to customer flow as well as trade 114. Price movements in different markets have posed various types of market risk. Thus, market risk can classify into equity price risk, commodity price risk, and risk currency. Secondly, credit risk is a risk involving inability or failure of one party, which is counterparty, to fulfill its responsibilities as agreed upon when signing the contract. Next, liquidity risk is the possibility of loss arising from the situation at where there is a lack of money to meet the demands of depositors and borrowers, or the sale price of illiquid assets is less than the current price. Besides that, the absence of buyers to buy illiquid assets when they need to be sold as well, causing liquidity risk to occur. And for the lastly, operational risk includes the possibility of failure in control, internal and governance of a company, causing losses financial. Another aspect included in this risk is system failure, information technology, and other related technology systems management of a company.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Ismi Muhammad Haris bin Ishaq. My matrix number is 1211718. So we're going to continue to the types of risk in Islamic banks. First and foremost, we must know that when we are on the Islamic banks, the types of risk that we must to face is first is the Sharia non-compliance risk. As we know that risk arise from the failure to comply with the Sharia rules and principles. Next is the rate of return risk. The potential impact on the returns caused by unexpected change in the rate of returns. It means that unexpected change in the rate of returns can have an impact on the profits or loss investment. And in Islamic banking, where the rate of return is based on actual profits, unexpected change can lead to the difference between the expected and actual returns. If the actual rate of return is lower than we expected, it can result in lower profits or even loss for investor. On the other hand, if the actual rate of return is higher than expected, it can lead to higher profits. And to manage these potential impacts, Islamic banks employ risk management strategies such as diversifying investments and provide transparent information to the investor. And by addressing the potential effects of unexpected change in rates of return, Islamic banks they aim to protect investor and maintain stability in the industry. So next is displaced commercial risk. In simple terms, these risks occur when a bank has to pay its investor more money than it actually earned. And to handle the risk, the bank takes steps to ensure its investment are doing well and keeps the investor informed about the performance and the risk itself. And by this way, it helps the bank maintain a good relationship with their investor or their lender and keep their money invested. And last, equity investment risk. The risk arising from entering into a partnership for the purpose of undertaking or participant in a particular financing or general business activity as described in the contract, and in which the provider of finance share in the business risk. This risk is relevant under Mudarabah and Musyarakah contracts. So that's all from me. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Miza Syed bin Azmi. My metric number is 1211684, and today I would like to talk about relation between risk and gharar. In the literature of financial management, risk and uncertainty, also known as gharar, are frequently used synonymously. But there are some distinctions between the two, and they stand for distinctly different ideologies. In this short post, we will focus on the key differences between risk and uncertainty as they are used in finance terminology. Risk in finance refers to the possibility of favorable outcome or the absence of a favorable outcome. There is no assurance that anything will occur in the present or the future, which is what uncertainty alludes to. Uncertainty doesn't have a predetermined result. There is practically any degree of uncertainty because no one can predict how an event will turn out. In other words, in the business world, uncertainty cannot be measured. It is a process that can only be described, not quantified.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Fikri bin Zamni, and my metric number is 1211697. And now we will proceed to the next point, which is Sharia compliance in risk management. In line with efforts to further strengthen the Sharia governance structure, the bank will issue a new governance framework for Islamic financial institutions under the bank's regulation to meet the following objective. Firstly, Sharia governance processes and arrangements with the aim of ensuring all its operations and business activities are always in line with the principles Sharia. Secondly, provide comprehensive guidance to the board of directors committees Sharia and the management of Islamic financial institutions in implementing his responsibilities related to Sharia affairs. And lastly, ensure proper Sharia compliance through the Sharia assessment function and an effective Sharia audit function.
For the conclusion, Islamic banks face additional risks due to their balance sheet and Sharia compliance. The non-availability of financial instruments hinders their ability to manage market risk compared to conventional banks. Sharia scholars must resolve fiqh-related issues, while government and regulatory authorities in different countries set up infrastructure institutions. Due to religious restriction, Islamic banks cannot enter the conventional banking market, but conventional banks offer Islamic product alongside their own product. Competition enhances efficiency, and a level playing field is essential for a healthy competitive environment. To ensure a level playing field, Islamic banks need similar supporting infrastructure institution. To introduce a risk management culture, Islamic banks should implement an internal rating system, risk weighting all assets separately. This can help fill gaps in the risk management system and enhance ratings by regulatory authorities and external credit assessment agencies. Okay, that's all from me. Thank you.